So, your sales are ticking along, you're generating decent revenue, but why on earth isn't your bank balance growing? If you're working harder than ever, but feeling like you're just running around going crazy on this finance treadmill, you're not alone. You see, as a fractional CFO, I've discovered that there's some common ways that e-commerce businesses leak cash. And I commonly deal with founders who are leaving literally millions of dollars on the table. In this video, I'm going to be showing you how to spot cash leaks in your business and, more importantly, how to fix them. Guys, my name is Nate Littlewood. I'm a fractional CFO who's helped dozens of e-commerce founders turn their cash flow challenges into growth opportunities. In this video, I'm going to be revealing a few things. Number one, the hidden metric that predicts cash flow problems before they actually happen. We're going to be looking at 8 proven strategies to free up trapped cash, including one counterintuitive approach that a lot of founders overlook. And I'm giving you a simple framework to actually prioritize and think through the various options on how to get more cash out of your business. But before I share these solutions, you need to understand 2 critical numbers that most e-commerce founders get wrong. And getting these right is the difference between constant cash stress and predictable growth. So it's really, really important that we just square away some of the theory here before we dive into the list. So anyway, the first key metric that you need to understand and pay very close attention to, because this number reveals exactly where your cash is getting stuck. And this metric or number is what we call the cash conversion cycle, or CCC. Essentially, it measures how long it takes for every dollar you spend on inventory to come back to you in the form of cash, right? So think of it like a stopwatch that starts the very, very moment you pay for inventory, and it's made up of 3 separate parts. The first part is how long the inventory sits on your shelves or your factory floor. The second part is how long it takes customers to pay you. And then finally, you've got how long you take to actually pay your suppliers. So in an example where we were holding on to inventory for say 90 days, and then you were waiting 30 days to receive payments from your customers, and you were paying your suppliers after 30 days, then your cash conversion cycle would be 90 plus 30, take 30, equals 90 days, which basically means 3 months that your cash is being tied up. Now, the problem with a long cash conversion cycle is that when cash is locked up in here, it can't be used for other things. So that's 90 days worth of cash flow that you cannot access for advertising, you cannot use it for hiring, and you're unable to invest it into new products as well. So let me ask you a question here. What would you guess is the ideal cash conversion cycle for an e-commerce business? I've actually got some great data on this, and I'm going to be sharing that towards the end of this video. So I do hope you'll stick around for it. The other metric that we need to be aware of and thinking about here is the working capital efficiency ratio. And to understand it, we first need to define exactly what working capital is. So working capital is the money tied up in your day-to-day operations. It's your inventory plus your accounts receivable, which is money that customers owe you, minus your accounts payable, i.e. money that you owe to your suppliers. So think of it as the cash you need to keep your business running and, the wheel spinning. Now, the working capital efficiency ratio is a simple but powerful calculation. It's basically your annual revenue divided by your working capital. So think of it a little bit like a multiplier, if you will. It essentially shows how many dollars of sales your business is able to generate from every dollar that you have tied up in the business. So for example, if you were using $100,000 in working capital to generate $400,000 in sales, that would be a 4-to-1 ratio. And so the higher this number is, the more efficiently your business is using its cash. Now, I'll show you a breakdown of these ratios across a whole bunch of different e-commerce businesses and sizes later on in the video, and you might actually be shocked to see where your business sits on this scale. Many founders I work with discover they're leaving thousands and thousands of dollars on the table once they understand this metric. Okay, so there's a lot of theory there, but it was important that you understand some of these ways to measure cash and cash flow efficiency before we get into the 8 solutions that I wanted to talk about in terms of how you can actually improve your cash flow. Now, here's the key. Which strategy you should implement depends entirely on your current cash conversion cycle and working capital efficiency ratio. Keep these numbers in mind though as we go through each solution, because I'll show you exactly how to match the right strategy to your specific situation. Okay, let's start with strategy number 1, which is basically reducing inventory costs. Now, this is essentially about paying less for each unit you buy, and it's often overlooked because most founders spend more time focusing on revenue than they do COGS. But I've worked with some founders who just don't feel comfortable having conversations with their suppliers about costs and money and finance related things. They find it a little bit awkward and uncomfortable sometimes. But remember, as the saying goes, if you don't ask, you don't get. And you have to be bold enough and willing to have these conversations if you want to get what you want, okay? Here's the thing. Most suppliers want to see you succeed, okay? They want to see you sell more product so that they can make more of it. Trick to negotiating lower prices with your suppliers is to position it as a win-win. Well, how do you do that? Well, you could say to them, hey, lower prices means I'm going to have more budget available for marketing, right? And if I can increase my marketing budget, it means I'll be selling more, which means more volume for you, Mr. Supplier. So it's a win-win if you can give me a better price because, we'll both benefit from that, right? So some of the other things that you should be doing on a regular basis here is negotiating volume discounts with your suppliers. You should be comparing costs across multiple different suppliers and know what your options are. You should be looking for opportunities to make or receive bulk order discounts. And you might also want to consider different packaging and shipping options from time to time. The thing to keep in mind here is that the savings add up faster than you think. So you always want to keep your eyes open and look for these cost-saving opportunities. Strategy number 2 is about liquidating slow-moving stock. Before you can do this effectively, you really need to understand the performance of your business at the SKU level. And what you want to do is basically put together a SKU hierarchy. The way I recommend you do that is categorize every SKU into class A, B, or C. Now, class A is going to be the top 20% of your products, and they're likely to be generating, maybe 75, 80% of revenue. Class B will be the middle 30% of products that might be generating the next 15% of revenue. And then class C is going to be the bottom 50% of your product catalog. And chances are that may only be generating about 5% of total revenue, right? So once you have gone through and categorized your inventory, you can use these specific tactics. Number 1, you could create bundle deals, and where you basically take some of the slower moving inventory and bundle it with a faster moving product. You could offer flash sales for seasonal type items or, slow moving items. And you can also implement clearance pricing on aged inventory. But the point is that these, class C inventory items are usually taking up space, you're paying rent for them, they're consuming real estate in your warehouse, and there's a very, very good chance that the profit that you're generating on them may not be enough to warrant the cost of carrying them. So just get them cleared out. Okay, strategy 3 is all about renegotiating payment terms. And this is where things get really interesting, and it ties directly back to those cash conversion cycle numbers that we were talking about earlier, and then I'm going to show you again a bit later in this video. And I guess the point I wanted to make here is there's a good chance that your suppliers might be a good deal more flexible than you think. Here are some things that you could potentially try to bring up with your supplier. Number 1, you could attempt to extend the payment terms as you build trust and a track record with your supplier. You could also do what's called a hold and release agreement. I'll explain this more more in a moment. The next thing you could do is establish volume-based payment terms, which basically means that the more you order, the longer you get to pay the invoice, right? So that you have time to sell through that inventory. Strategy 4 is all about optimizing your accounts receivable. Now, optimizing AR or accounts receivable basically means getting your customers to pay you faster. And there's a few ways that you could potentially do that. The first and most obvious way is that you could offer early payment discounts. Even 1 to 2% can actually have a pretty big difference. You can also make sure that you're very, very clear on your payment terms up front so that people know in advance what your expectations are. I would also recommend that you automate the entire process of follow-ups here, right? You should not be running around chasing people for money. You should have emails and automations doing that for you. Okay, strategy number 5 is that you can implement seasonal-based ordering. And this is particularly relevant for businesses that have a lot of demand or sales volatility throughout the year. Now, the problem is that a lot of inventory management and ERP systems will allow you to set reorder points for your products, which is somewhat helpful from a time-saving perspective. But in my experience, it's not actually that great from an inventory optimization perspective. You see, there's probably going to be times of the year when 5,000 units of inventory is an absolute mountain and it's way more than you need. There might be other times of the year when 5,000 units doesn't really represent that much. I mean, it could only be, say, I don't know, like a few weeks of sales. So rather than think about reorder points in terms of the number of units that you have, I prefer to think about reorder points in terms of the number of weeks of cover that we have. This basically means that instead of reordering a product when we have 1,000 units left, I want to shift and be reordering when we have, say, 8 weeks of supply left. Okay, hopefully you see the difference there. Okay, strategy number 6, I touched on this earlier, but it's basically to use hold and release agreements. The way these work is you basically negotiate a deal with your supplier whereby they hold on to the excess inventory on your behalf. The supplier still produces in large quantities and therefore they still get to enjoy their economy of scale benefits. But rather than ship and invoice you for everything all at once, they'll instead actually just release the inventory in batches and only invoice you as those smaller shipments go out the door, right? Strategy 7 is about invoice and purchase order factoring. Now, this strategy only really works for businesses that are selling into retail and as a result are receiving purchase orders from their customers and they're carrying an accounts receivable balance for those customers. Factoring is basically a financial strategy that allows you to turn a purchase order or an accounts receivable balance into cash quicker than you otherwise would. So on the accounts receivable side, the way that this works is that when you ship a product to a supplier, they will have an accounts receivable balance. And normally you might have to wait, say, 30 or 60 days for that customer to pay you, right? But if you go to a factoring company, they might be willing to pay you as much as 80 to 85% of the value of that invoice, and they'll give it to you immediately. Then when the client does eventually pay, a month or two later, that money goes to the factoring company, so they get repaid. They will take their commission or fee from it, and they'll give you whatever is left over. So at the end of the day, you do get less than 100% of your revenue, but the benefit is you get to bring forward the timing of your revenue quite significantly. I actually helped one of my clients with an $800,000 factoring facility last year as part of their expansion into Sam's Club. Okay, so strategy 8 is a cost-cutting exercise. A lot of the stuff we've spoken about up until this point really focuses on the operational side of the business, but strategy 8 is much more about the overhead or indirect costs in your business. And this strategy is all about using zero-based budgeting or ZBB. So the status quo with budgeting is that we normally just assume that our budget for a given line item in the P&L be the same as whatever we had last year, okay? And any changes to this budget are based off, whatever the prior year number was. In zero-based budgeting, we set budgets for everything to zero at the beginning of the year or the period. One practical way to do this very quickly is just to cancel all your credit cards and create new checking accounts for the entire business. This forces vendors on auto payments to reach out to you again if they want to get paid. So with zero-based budgeting, you basically go through every line item. You ask yourself, do we actually need this? And what is the business justification for it? So this forces you to have to re-justify every expense from, square one, right? Okay, so there's our 8 cost-cutting methods, right? What I wanted to talk about now is show you some of the data that I promised earlier and actually look at how these cash conversion cycle and working capital efficiency ratio numbers, what they actually look like for real-life businesses. So some of the things that I encourage you to ask yourself here as you're looking through these data sets is firstly, how does your cash conversion cycle compare to some of these metrics? Where would you sit on these comparisons and this chart? Next question is, what does your working capital efficiency ratio look like? And where would that put you on this chart? Are you at the high end, the low end, or somewhere in between? And the next thing that you can ask yourself is, which of the 8 strategies that we've talked about here best aligns with your business? Where is the low-hanging fruit for you and your e-com business? Now, for most businesses, what I recommend at this point is to basically get clear on the order that we're going to attack these opportunities. So the first thing you want to look for is quick wins, right? That's things like, liquidating stock and cutting expenses, for example. Then you're probably going to have some medium-term opportunities, which would be things like renegotiating payment terms and maybe optimizing your receivables. The third wave is a longer term stuff, and that might be things like implementing seasonal ordering or negotiating the hold and release type agreements that we spoke about earlier, right? So just to wrap things up here, you now have both the metrics to track your business and the strategies to improve them. More importantly, you know exactly how your business compares to other companies in the market. If you'd like to have a go at calculating your own numbers and seeing how your business stacks up, I have included a link to the file that I'm showing on screen right now in the comment section below, in the description rather. You'll be able to use that to calculate your own cash conversion cycle and your own working capital efficiency. And in doing so, you can see exactly where your business sits compared to these others. Guys, that's all I got for you today. Thanks for tuning in, and I will catch you next time.